For decades, Canada's economy was closely intertwined with that of its southern neighbor. Roughly 75% of Canadian exports went to the United States. But a barrage of unexpected tariffs and trade threats from President Trump has begun to rewrite that story. In 2025, multinational firms and foreign governments are increasingly courting Canada as a stable alternative, drawn by new trade deals and a more predictable policy climate. This documentary looks at why companies from autos to tech are redirecting investment northward, citing real examples, data, and the voices of decision-makers on both sides of the border. When Trump took office, he promised to shake up trade. He quickly slapped 25% duties on Canadian steel and aluminum in March 2025 and threatened 25% tariffs on cars and parts. His aides even floated a 10% levy on all Canadian energy exports. The result was economic shock. The old relationship with the United States is over, declared Canada's new Prime Minister, Mark Carney, during his 2025 visit to Washington. Canadian firms braced for impact. As Reuters reported, a British Columbia capsule maker began scouting Asian partners, and even a costume manufacturer slashed US prices. If you are a smart-savvy business person, you are not going to jump right back into another arrangement where you are totally reliant on a US partner, warned trade consultant Mike Chisholm. He notes that owners, banks, and investors all crave stability, and they are now eyeing other markets. PNP Pharmaceuticals in British Columbia, for example, is venturing into other markets like Asia to hedge against America's volatility. Label pack printing is even focusing only on Canada and shrinking its US sales, afraid that if Trump gets mad and throws a 50% tariff on Canadian goods, it's going to really put us out of the market. These anecdotes reflect a broader trend. Canada's businesses are retrenching at home and overseas while the US trade scene swings unpredictably. In March 2025, Trump imposed 25% tariffs on all steel and aluminum and announced 25% on non-NAFTA compliant cars and parts. Canada answered in kind, with 25% duties on $155 billion of US goods, including iconic items like bourbon, wine, and even Florida orange juice. Prime Minister Trudeau warned Americans directly that tariffs against Canada will put your jobs at risk, potentially shutting down American auto assembly plants and other manufacturing facilities, and would raise costs for you, including food at the grocery store and gas at the pump. In the US, auto executives and economists warned that 25% auto tariffs would sharply raise vehicle prices. Ferrari preemptively announced 10% hikes on US sales. In Michigan, business groups pleaded with Trump to stop the plan, warning that in Michigan, where 1 in 5 jobs is automotive-related, the pain felt by working-class citizens will be profound. These tensions have prompted Canada to seek new friends in trade. Ottawa's strategy is twofold: retaliate where needed, but more importantly, cultivate fresh markets. Canadian officials speak openly about predictability, a key word. International Trade Minister Mary Young noted that the new Canada-Indonesia Trade Pact is about creating predictability of our trading relationship. By contrast, US policy is seen as erratic. Even Canada's central bank warns that the unpredictability of US trade policy could cause further market volatility. In late 2024, Canada signed a landmark comprehensive economic partnership with Indonesia, a G20 economy of 280 million people. The CEPA, effective 2026, will eliminate over 90% of tariffs on Indonesian goods entering Canada and deepen investment ties, especially in critical minerals like nickel and bauxite. Indonesia's Trade Minister Budisto lauded Canada's support for Indonesia's plan to grow its critical minerals industry. Canada is also pursuing broader Indo-Pacific engagement. Its official Indo-Pacific strategy, with $2.3 billion over 5 years, highlights a market of 40 countries, 4 billion people, and $47 trillion in GDP, including 6 of Canada's top 13 trading partners. The aim is to diversify beyond the US, tapping booming Asian markets. Canada boasts trade agreements covering over a dozen countries. In addition to Indo-Pacific deals, Canada's free trade network includes CETA with the EU, CPTPP in the Pacific, and USMCA in North America. Global tech and energy firms value Canada's resource stability. Indonesia, rich in nickel for batteries, now sees Canada as a trusted partner on the energy front. While Trump has threatened a 10% tax on Canadian oil, Canada has retaliated by targeting U.S. energy imports. By locking in these agreements, Canada is sending a message: its trade policy will be steady and collaborative, not volatile. As Mary Ang put it, the Indonesia CEPA creates predictability for businesses. In 2023 to 2025, this strategy has already begun to pay off. Even companies that used to view the US as a given are now taking a second look at Canada. The combined effect of US tariff risks and Canadian incentives is forcing companies to reconsider North America's geography. Multinational corporations are increasingly choosing Canada for expansions, citing stability and access to markets. Many Canadian manufacturers are telling US clients that costs are rising thanks to tariffs, effectively passing on the price hikes. "We are talking to businesses and telling them their government has chosen to have them pay more," said James White, CEO of a Canadian steel component firm. Other firms are rewriting contracts to share tariff costs. One Montreal-based steel distributor warns its US sales could more than double in cost due to layers of tariffs, which means eventual price increases for US buyers. In response, smart investors are hedging their hiring Canadian sales agents, setting up European offices, and generally shifting investment away from the uncertain US scene. Tech giants and suppliers see Canada's appeal for R&D and production. For example, Foxconn, the Taiwanese contract manufacturer and Apple supplier, has emphasized its worldwide footprint to weather US trade shocks. "Clients may decide to shift production locations, but we are ahead," Liu said. "As a result, the impact on us is likely smaller compared to our competitors." Likewise, Canada is investing in its own semiconductor sector to attract chipmakers, a sector where US policy has been heavy-handed and protectionist. Even the auto industry's giants are feeling the shift. Several major car makers publicly warned that Trump's 25% auto tariffs would hike vehicle costs for consumers. For instance, unconfirmed reports in 2025 suggested Honda was reconsidering its planned $15 billion EV manufacturing project in Ontario, partly due to uncertainty over US policy. Meanwhile, Canada has been courting automakers with incentives and continental tax credits under USMCA. In energy and raw materials, global firms are weighing Canada's resource potential against US unpredictability. Canada is a proven supplier of oil, natural gas, uranium, and lumber. Unlike the US, it has signed stable trade rules, including an investment chapter under USMCA. In all these cases, the underlying message is consistent: stability matters. So multinational CEOs are watching the map and increasingly drawing business plans that